How's it going, boys and girls? My name is Andrew, and this is Professor Meatball, and we are currently talking directly to you. We're talking about the question, why is the squeeze not Squoze yet? We got some pretty good DD from 2 days ago in the weekend, and I think you guys are going to want to stay until the end to talk about it. So I'm going to move my face over here, and we're going to have both the price of GameStop over on the left-hand corner. It closed today at $119.50, and it is currently hovering around that price. And we are going to read this DD together. Now, bear with me, apes, this is going to be a long one. There are many reasons why the squeeze has not been Squoze yet. Technical similarities compared to last time. If you look at the volume activity on the 13th to the 19th, there is huge volume spike compared to the previous weeks that coincides with a small price bump. It's actually big, but it's GME we're talking about, so they're speaking to relative terms. Then the volume decreases and the price levels off. Then on January 21st, Friday, we GME have the biggest volume it's ever had in a day. However, this only raised the price to about $70. The next few days, volume that was not as high as the day, but still higher than the other days before and after, the price got about $150. Then on January 27th and 28th, that's when we see the price get to its highest point ever. But volume is only about half of what it was in the previous day. So after that, we all know what happened. Now compare that price and the volume action to now, and I think we have something similar. They think that the week's price action and potentially next week's and the volume coincides with the volume and price action of the 13th to the 19th, as it spiked from recent levels and the price has cooled off and stabilized. Another thing that we see is on the MACD, the 1-year chart had a bullish convergence. For those of you who don't know what that means, it means that the price action has started a bullish trend. The last time it did that on the 1-year chart was in early January when the squeeze was taking form. It's also very important to consider that the day of the week in this equation, because of how option expiry works, Fridays are going to be the worst days for the stock, as market makers will try to push it down so that they aren't obligated to exercise a larger number of options. So that's why today was pretty red, although not horribly. This was back submitted 2 days ago. Expect this to going in the future and keep that in the back of your mind. Another important point, similar market conditions. Look at the market conditions from last time and compare it to this time. SPX down massively, VIX up massively, then and now. Do you think that because the market correction is only because of the bond yields, even then JPOW promised no rate hikes for at least a year? No. It's because funds are having to liquidate other positions to cover GME shorts. Conflicting short interest numbers and comparisons to last time, the short interest numbers that are available are very conflicting. Some sites say it's 41%, which is still huge. Others say it's 15 to 20%. The issue with this is that sites are updated only 2 weeks or 1 month, so most of this data is reflective of the post-squeeze when the short interest was lower. However, Fintel updates the available short shares regularly, and yesterday it was 0 by 1 point, and it got up to 600,000, and has been declining to about 400,000 now. This leads the poster to believe that the short interest has gone on massively because hedge funds are greedy people who don't learn their lesson, and that once it is updated, we will see a short interest that is back up sky high. Yeah, they bet that a few people are interested in this. The overarching thing to take from this is that there is still short interest, possibly massive short interest, and that short may have gone down significantly. This is exactly what happened last time, and continued movements in these patterns are exactly what we need. As a little sidebar, just look at AMC. It's also repeating the same pattern as GME. Is it this because AMC has the same short interest propositions as GME? Probably not. They think that AMC just rises with GME, but this is another interesting similarity to last time. Karen Smith says, I love your two squishies. I think this is my biggest squishy here. That's Professor Meatball. Let's see, just as a little Robinhood. As they said before, the reason that the stock went down last time was because of brokers restricting and buying, but not selling. Not because the squeeze was over and funds covered or put more downward pressure on it. They would bet that Robinhood and other firms will not restrict buying this time unless it goes above 1,000, because A, they are much more liquid than they are of now. This is true. They mentioned it in the congressional hearing. And B, they do not want another one of those press nightmares. Obviously, if it gets too high, they're going to have to restrict again, but they they think that they are safe at this front until it gets higher than last time. They also want to point out that the CEO of Interactive Brokers even said on CNBC that the price of GME would have gone up to over $1,000 if the brokers didn't halt buying. So they don't underestimate their power. They just want to emphasize that if it gets sufficiently high again, they will undoubtedly have to restrict again. So any talk of this getting above 5 figures is unlikely to be true. And I even covered exactly what Josh, the Hey It's Pixel end game due diligence man, thinks about $100,000. If you are surprised when GME goes above 500, do not be surprised when brokerages ram you. And we're not going to say the other word in that sentence. Short interest. Last time we undoubtedly had a short squeeze as short float was over 100%. This time it appears to be at 40%. Now this is interesting because this poster thinks that the last price change was because of a short squeeze. Therefore, there will probably not be a short squeeze like last time. However, because of options activity, there could be a gamma squeeze that could then trigger a short squeeze for these 40%. Interesting because most people agree that the last time in January, the activity was due to a gamma squeeze. If this is the case, that makes them believe that there's significantly higher in short interest than their websites are reporting. In this situation, however, the short interest is not as important as the options activity. How does out-of-the-money calls can multiply this? The reason why last gamma squeeze was because market makers had to hedge the massive OTM calls that were becoming ITM, meaning that they had to buy more shares, and buying is good for us. This means that hold on a second. Yes, however, at the time, the most OTM strike was something like 200 to 300, eventually getting up to over 500. Now, because of the last squeeze, we have OTM calls with strikes of 800. That means that if the price keeps going up, there's going to be a massive feedback loop of market makers having to continually cover that could lead to an even bigger squeeze than last time. Like I said above, a short squeeze like last time is unlikely because of the short float, but because of option activity and renewed interest in the stock, we could see an even bigger price hike due to the gamma squeeze that could also force the shorts to cover, which would trigger a small short squeeze. Think about it as like a couple of rockets that have to jettison one after another, and that is currently what we're dealing with. The catalyst. One of the most important things that they've learned about GME is how Wall Street Bets reacts to its catalyst. This stock has shown us that it reacts very strongly to catalysts, especially the ones dealing with Ryan Cohen and leadership. As we know, the first one was triggered by Cohen becoming a large owner of GME. This current one was triggered by the CFO being ousted. That is still contentious, but perhaps partially by Cohen tweeting about an ice cream cone. As Andrew Left from this company said, he thinks that GME could dilute some shares and make an acquisition. This would hurt it very short term, but most probably lead to an overall massive growth after a small dip because speculation interest on the stock would skyrocket. We also have the possibility of Ryan Cohen making more moves such as hires, appointing himself CEO, acquisitions, more tweets, etc. Most of all, we have earnings on March 25th. This is something that Josh, Hey It's Pixel, also talked about in his DD. They're going to take a guess and say Cohen and the board will likely make some kind of announcement or statement that will lead to this thing running up massively. They believe that this would push this up to the highest level possible and could trigger the above mentioned short plus gamma squeeze. This would happen the next day, March 26th. That also perfectly coincides with the end of the month, which is when market makers would have to really start hedging against these super OTM calls, which would trigger a gamma squeeze. Quite honestly, because of Wall Street Bet interest in this and the continued short interest on the stock, they could see that this happening every single time there's a catalyst, especially at the end of each month. Now, that's actually some pretty good news. If you were looking about dates, like specific dates where the squeeze could happen, this poster is starting to say that, you should actually just start thinking about how every month is a chance for the squeeze to happen. Will, thank you for the super chat at Uncle Bruce about podcast. He's down. He said email him. I want his email. Maybe I'll find it on his YouTube channel. Maybe when this video goes up, you guys will already see that cool collab. Okay, so that was the catalyst. The point of this is that it's not over. The squeeze will likely take longer than the first one, but could easily be much larger if people continue to hold in good times and in bad. This article makes great points about how it could take longer than the last squeeze, and you should read it if you want to. It's pretty short. The diamond handers who help after the first squeeze are getting rewarded during this one, and anyone who keeps holding will rewarded in the next one. Hedge funds are undoubtedly on this sub right now spreading misinformation. Just know that these people have a lot of skin in the game and still massively exposed and vulnerable to even bigger squeeze. If we know anything, it's that Wall Street doesn't learn after it F's up like in 2008, and you can bet your butt that the funds still have massive short positions and won't sell until GME goes to zero, or Wall Street bet puts the funds to zero. Thank you for the super solid snake. Love the content. What are your thoughts on Tesla? I'm very bullish on Tesla, but unfortunately right now it's pretty volatile. So let's see. Stay strong, apes. If the stock goes past 800, my wife's boyfriend has promised to let me sleep in the garage instead of under the deck. Not a financial advisor. This is not financial advice. This is just a dude with a small wee woo. So hopefully this video made a little bit of sense about exactly why the squeeze has not yet happened. It helps give you a little bit of context of when to expect deadlines instead of having a sense of that a deadline must happen by March 19th, which might be counteractive to the squeeze itself. Expectations is the thief of joy. Always remember to never invest more than you're willing to lose. And I think for now, but not for forever, have a great day, and I'll see you guys in the next one.